a panel discussion on passive investments. There's a very starkly shocking statistic that 50% of mutual fund investments are actually redeemed within 1 year. Passive investing is, however small that expense ratio might be in difference, still appeals to that cost-conscious middle net worth investor. Each of our speakers on the panel today represent a different force reshaping passive investing. So let's have a round of applause. First up for Prateek Oswal, Head of Passive Funds at Motilal Oswal Asset Management Company. Swaroop Mohanty, the Vice Chairman and CEO of Mirae Asset Investment Managers India. And finally, of course, Vishal Jain, CEO of Zerodha Fund House. And moderating this panel, we have Neil Barate, Editor-in-Chief, The Fine Print.
Prateek, if we can start from you. If you can give us your philosophy for passive investing and for this FOF or concept of FOFs.
FOFs is a pretty interesting instrument. When we looked at index funds, ETFs. So just to take a step back, if you look at passive in India, index investing prior to 2019, we only had Nifty and Sensex. These are the only two indexes available. And then post maybe 2020 onwards, index funds, ETFs became a lot more broad-based. You had international, you had fixed income, you had thematic, sector. You had more broad-based funds like mid-cap, small-cap. So I think the FOF structure, which I think Neil is talking about, is something that personally, I was very excited about because that, is basically a solution for a lot of investors' portfolios. The idea was that, we launched about 10 to 15 funds, and people kept asking us which is the best fund to buy, which, when it comes to passive. And it's very hard to really answer that question because everyone's very different. So the point of the FOF, which is a multi-asset fund, is to basically have a single sort of solution to a lot of investors' needs of buying mutual funds. The reason why multi-asset works really well as an investing philosophy is because as I think Keval said earlier, is that we really when you're building or when you're constructing a portfolio. If you look at global portfolios, some of the best constructed portfolios, almost all of them have a multi-asset portfolio because it's impossible to predict what will do well at the next year or the next 2 years or the next 3 years. No one really predicted that gold and silver would do well in the last 1 year. And nobody really predicted that the US indexes would have done well this year as they have. So the idea behind having a multi-asset portfolio is to essentially make sure that you are invested in multiple asset classes because you don't know what will do well at what point in time. And also what it does is sort of hedges your Indian equity exposure in case the Indian equity markets don't do well.
There's one thing that at least the past year has taught us, multi-asset has a place, a strong place. We don't know how long this period of stagnation will last, but anyone who's in a multi-asset fund has certainly done much better than some of the pure equity guys. So the second famous launch of a multi-asset passive fund, of course, is by the gentleman next to me, Vishal. So can you talk us through why you launched it, what the construct is, a bit more about?
Most investors, when they want to start investing, there's always that big question in your mind in terms of how much should I put in equity, how much should I put in debt, how much should I put in commodities, right? Objective being simplicity, that when a person gets into it, he knows exactly what he's getting into, and not some kind of a quant model behind which is looking at maybe where the market is or where PEs are or some other factor that is there. So the take is more on giving a very simple product which somebody can keep investing in forever.
Swaroop, can I get your view on multi-asset and passive multi-asset in particular? And then I want to talk about how people behave with passive funds.
So I think the biggest unlearning post-COVID has been multi-asset. And I disagree with you in your sense that let's see how it performs or figures. I think slowly but surely, multi-asset has to become the core of our portfolios. The power of asset allocation actually comes out, and if you look at data, the possibility or the probability of getting median return over a longer period of time, 10, 15, 20 years, is higher through a multi-asset structure than a single asset structure, and I'm including equity in that discussion. Multi-asset probability gives you higher even from an equity perspective, what you used to buy and what you will buy may not have any correlation. Debt is perpetually in this play in this global central bank turmoil. So rarely do you find a situation where all three asset classes look good to you, and you're very fortunate to be an advisor, distributor, or an investor at this moment. And then the multi-asset structure is probably the most logical thing. I met a very senior person from London, one of the CEOs of one of the largest stock exchanges of the world, and she told me that 80% of retirement money of Europe goes into multi-asset structures. And if we still debate, then you're running out of time, as simple as that.
Sort of the other point is about how you look at passive funds. So far, the argument is always cost, low cost, low cost, low cost. You've had, investors in your passive schemes for many, many years. Do you find people to be more sticky with them? Is it that it takes the cognitive load off, that if your fund is underperforming, passive is better, because by definition it can't underperform? So have you seen that?
I'll say this with all due respect to Pratik and Vishal, both are specialized passive guys, but understanding passives has been probably the most learning process of my last 5, 6, 7 years of doing this business. But sooner we control our bias and get out of what is right for the customer, the easier it becomes. We are fighting so many biases. The moment I start talking about passive, the whole world will say, "Arey, active ka banda passive kaise baat kar raha hai?" They're two different businesses, right? Two different standalone businesses running different challenges. And let me tell you, running the active business is extremely passive. Running the passive business is extremely active. And we have one rule in this business: what is right for the customer is right for us. Look at the bias. No, index is the right thing. Why? So whether it's active or passive, the product change that has to happen is going to be pretty dramatic. So sooner we unlearn, the better. And that's the process I'm going through. And I'm so happy at this age I'm going through that process.
So Vishal, on that note, is the business model that you are pioneering, which is direct and passive, the future? Have you seen that in the data? Is this old world going to vanish of distribution and active funds?
See, Neil, I think it's too soon for us as a country to, decide on which distribution mode is going to succeed or is going to disrupt. I think we're too nascent at this point of time. Look at the penetration in any financial product. Look at insurance. Insurance is at about 3.8, 3.9% of the Indian economy. We keep talking about, say, Viksit Bharat and 2047 and things like that. I mean, imagine the number of people you need, to be financialized for you to become a developed economy. That means if you look at any developed economy, right? I mean, and I don't know if US is the right country to look at, but US is at 110, 120% or so. If you look at global averages, they're at about 65% or so. We're at 17% at this point of time, right? You'd require at least 50% of your population to be buying some kind of financial product or another, right? Which means you need another 60, 70 crore guys coming in to the mutual fund or to, buying financial products. Now, we've reached 5 crores in 30 years, right? As even the previous panel said, we don't have another 30 years to reach out to 5, 6 crore more people. And therefore, then how do you reach out to these 50, 60 crore guys who are there in the system? The first thing that you need to see is you need to give them simple products. So I look at passive as a kind of entry point for a lot of investors who are not there today to come in and start using some form of mutual fund products. So to me, it's a fantastic way for a country like ours to be able to kind of open the doors to people. So to me, passive is what is going to open the door to people investing in mutual funds. And from there, we'll kind of, once they have an experience and once they've made some money on those products, they will then start asking for, what else can we do now, right? So I see that passive is a way for us to kind of expand the market in a very fast manner in a country like ours at the kind of stage we are at.
Pratik, you've done some daring launches over the course of your career. Can you give us a sneak peek into what might come, either from you guys or from the industry? What is the trajectory of passive funds going forward?
So I think in terms of launches, there's two competing philosophies I see in index funds, ETFs, and I think it's been pretty interesting, I would think, realizing how the industry has grown over the last 5 years, not only in India, but also globally. So if you look at the Vanguard or the John Bogle version of passive, the definition of passive means buying the market. It's very simple. US, you have the S&P 500, buy the market. The market knows everything. We as investors who are buying the market will probably do extremely well. The S&P 500 in the US has been around for half a century. I don't think any other, very few, maybe handful of mutual funds that have been around for that long. And I don't think a lot of them have managed to do better than that.
All right, what an interactive session. So Vishal, Swaroop, Prateek, thank you so much for joining us today for the panel. Neil, thank you as well.